Very important. I'm not allowed to start before I'm given the signal. Welcome everybody to tonight's event here at LSE. For those of you who don't know me, I'm Charlie Bean, these days Emeritus Professor of Economics here at LSE. I'm going to start with a few logistical announcements. First and most importantly, please make sure your mobile phones are switched off or set to silence, and particularly the speakers who regularly forget to do that. For those of you who post on social media, taking the chance while you still can before it's outlawed, the hashtag for today's event is #LSE Central Banker. The event's being recorded and we plan to make the video available on the Financial Markets Group website. There is also a photographer here to capture the event, and a selection of photos will be posted on the website as well. If for any reason you don't want to be in the images which may be published, can you let us know after the event? Fire alarms. If you hear a fire alarm, it's not a practice. Please calmly leave the building via the fire exit and following instructions from the staff and stewards. And as usual, there'll be a chance to put questions to the speakers after their presentation, and I will obviously compare that Q&A. Well, tonight we're delighted to be hosting the book launch of The Unanchored Central Banker by Charles Goodhart and Manoj Pradhan. And it's my pleasure to introduce the two authors. Charles Goodhart is widely recognised as one of the country's most distinguished monetary economists, having pursued a career that's alternated between academia with spells at Cambridge and then more recently at LSE over many years. And on the other hand, public service at the Bank of England, initially in the first part of his career, and then later as a founding member of the Monetary Policy Committee. I think I should also record that together with Mervyn King, he founded the Financial Markets Group here at LSE, where he's now Norman Sosno Professor Emeritus. Amongst other things in his long career, he's responsible for devising the corset in 1974, for those of you who know what that was. I'm old enough to remember it, but I suspect many people here won't be able to go that far back. But more recently, he was involved in advising the Reserve Bank of New Zealand over their early introduction of inflation targeting, which obviously set the stage for many other central banks that followed. And that was in 1988. But he's probably best known as the author of Goodhart's Law, that any observed statistical regularity will tend to collapse once pressure is placed upon it for control purposes. Manoj Pradhan is the founder of Talking Heads Macroeconomics, an independent research firm based in London. He was previously managing director at Morgan Stanley, where he led the global economics team, driving macroeconometric research into global economic themes. And before that, he was on the faculty at George Washington University and the State University of New York. In 2020, Charles and Manoj published a book entitled The Great Demographic Reversal, which focused on the macroeconomic impact of global demographic forces and correctly predicted the end of the prolonged period of disinflation and falling interest rates. And their latest book builds on some of the ideas in that volume. Charles and Manoj together will speak for about 3/4 of an hour, and at that point we'll switch over to Q&A. So over to you, and I think Charles is going to lead off.
Thank you very much, Charlie. We've had a very long, fruitful career together. both in the bank and here at LSE. I'd like to do a quick reprise about our first book, about the demographic sweet spot turning sour. And it was an extraordinary, huge, positive supply shock. There were two main features of it. First one was the arrival of China and Eastern Europe into the world's trading arrangement in the early 1990s. The second was a major long-term change in the proportion of women entering into the working population. When I was young, alas, 60 or 70 years ago, the proportion of women in the working population was about 25%. Over the decades that followed to about 2010, it rose to about 75%. In other words, a 50% increase in the proportion of women working were themselves 50%. So that means there was a 25% increase in the working population in virtually all of the advanced economies. Put those two together, and you've got just an enormous positive increase in supply. So no wonder you had disinflation and an increase in the growth of output, a massive positive supply shock, which was effectively represented by the fact that in the years from 2010 to about sort of 2020, central banks struggled to get inflation back up to target. Now, that was temporary. It was extraordinary that people didn't realize that historically it was unique and temporary. And our view then and since has been that nominal and real interest rates and inflation will go back much more towards normal, or perhaps, given the adverse supply shocks we're now getting, to a higher for longer steady state. And that all has brought about a massive increase in fiscal problems, in the fiscal deficit, and in the fiscal debt. A fiscal deterioration that when we wrote our first book, we had not really entirely expected. And it is really in large part about that fiscal deterioration that our book is now about, or the effect of that fiscal deterioration on central bank and monetary policy. When we wrote our first book, just as we finished it, COVID happened. So we finished our second book, just as we finished it, the Iran war broke out. There are many people asking me never to write. There's a slight difficulty with the presentation this evening because the main message about the fiscal deterioration and the effect of that on monetary policy has already actually been presented here at LSE by Isabel Schnabel a few months ago, in fact in the evening of April 7th. And quite a lot of you will actually have been there. And we have a slight problem in the fact that some of you we would find simply repeating all of that a bit tedious, and other of you really haven't heard of it that much. One of the things that I want to say is that central bank independence is not just about preventing politicians interfering. And the ECB, which Isabel, of course, is a key member of, is particularly well protected against political interference because it's protected by a treaty, much more so than most other central banks. And the problem that both Isabel and we were referring to is much more that the context, the economic context, particularly the fiscal context, and the context about what is happening in the government debt markets is going to constrain central banks and reduce their freedom of action to undertake monetary policy with a genuine room to act overall. So the quiet erosion of independence, as she said, and we agree, can come without any implicit or explicit change in the mandate, but through fiscal overextension, the resulting financial fragility, and a degree perhaps of mandate greed. So, are the glory days of central banking behind us? And they were glorious, actually, as a central banker. And the period, really, from the 1990s to pretty much the present day, have been without parallel. It's been splendid. But there's a problem. As we get into a much more highly indebted society, the central bank can only displace inflation over time. It cannot conquer it. This, again, is John Cochrane's fiscal theory of inflation. Given the fiscal problems and the implications that this has, if it decides to fight inflation today by raising interest rates, that will raise the cost of the debt, the more so as the debt becomes shorter, and it will also tend to lower growth, so that the important relationship between the rate of growth G and the interest rate R worsens steadily if you raise interest rates. That means that the attempt to raise interest rates to reduce inflation now actually has the effect of worsening, and significantly worsening, the overall fiscal problem. And the fiscal trajectories are fairly drear. The CBO's long-term debt GDP forecast, which was done last year, is now out of date. And it's much worse than it was last year, because you've got the massive increase in the fiscal deficit caused by the Iran war. And nothing, but nothing, really looks like happening to do anything about it. What's more, we got the problems of defense, and everyone knows about the resignation of the Minister of Defense, and we got climate change. And the combination of the rising prices of fertilizer and the problems of what's happening to climate could mean that food prices will start going up more than people already realize. This shows the chart, the increasing share in America of Social Security and healthcare, which is inevitable, and the deficits and debt show an increasing sensitivity to aging. And the fiscal position is not under control. The problem is frequently, in some part, a crisis of democracy. Because, as the quote from Jean-Claude Juncker says, we all know what to do, what we should do, which is to change the fiscal position so that the fiscal position becomes sustainable. But that involves raising taxes or cutting public expenditure. So we don't know how to get re-elected when we've done it. And if we don't know how to get re-elected when you've done it, on the whole, you don't do it. So are there any solutions to the fiscal problem? And the answer is it's jolly difficult. We ought to limit expenditure on the old, but the old vote and the young tend to vote less. So actually, everybody knows that the triple lock is unsustainable, needs to be reduced. But it would be pretty political bravery to actually do that. We know that we ought to change the welfare so that it encourages people to work rather than to live off welfare benefits. We should move rapidly to a land tax. I could go on for a long time, but I don't want to in this one. A land tax you can't move land, and it doesn't reduce the incentives. But trying to introduce a land tax that would shift the burden of taxation significantly from labor and profits to land would so immediately lower the price of housing that it could actually bring about a financial crisis, because most financial assets, or many financial assets, collateralized on the basis of land. One of the things that we do suggest is a no kids tax on grounds of fairness, not necessarily on grounds of fertility. If you don't have children and you grow old, you still get pensions. If you get sick and incapacitated, you still get looked after. Who pays those pensions and who looks after you when you're sick? And the answer is it'll be the other people's children who do that. And the other people who have such children have had to bear considerable costs in doing so. In other words, those who are childless are free riding on the basis of those who have children. But obviously, this kind of tax has got extreme difficulties. What do you do about those who cannot medically have children? How about adoption, etc., etc.? Flexible retirement age, and so on. There is no obvious immediate silver bullet that is going to change us from fiscal unsustainability to fiscal sustainability at any speed. The implication of that is that we're very likely to have financial repression as an interim stopgap, in the sense that the deficits that need to be financed are going to be so large, and the problems of inflation and the worries about whether the government can and will make such payments will mean that it's quite likely that the central bank, in order to maintain financial stability, will have to step in and support the bond market from time to time, or else the bond market will crash, and that too will have its problems. But if the central bank has to step in from time to time to support the bond market, what about the fact that that will be monetizing the deficit and encouraging inflation? So the answers will tend to be lots of kinds of financial repression, lending controls, taxes on banks, forced holdings of government debt, the corset, which Charlie kind of reminded. That's where I came in. Back towards the end of 1973, interest rates had been risen from about 6% at the middle of the year to 13% by the end of the year. The government, Ted Heath and Barber, then effectively told the Bank of England, you can't raise interest rates anymore, but you've got to bring monetary growth under control or actually slow it down. And then reintroducing direct controls over bank lending would have been a humiliation for the bank, which had just issued competition and credit control and got away with them. So what I did, and it was my device, was the corset. But I'll leave it to you to read up about how the corset worked. I think if we're going to go and have financial repression, I do hope that people will read it up, because it's probably about the best form of financial repression that you can have. Now, finally, for me, the question about interest rates. Most of the models of interest rates look only at the private sector. The balance between those who are growing older, saving for their old age, and those who are old, dissaving. And that's relatively encouraging. But the problem is that the interest rates that actually we all worry about are those on public sector debt. And it's the public sector position that is so intractable and so difficult. And most of these models don't have an appropriate public sector, nor do they have a housing sector. In most of these models, people don't live anywhere. They don't have any families. Although there are going to be fewer young, there are going to be many more of us old. And that means that populations are going to rise inevitably and inexorably to about 2040. And us old have quite largely paid off our mortgages, and we don't like moving. It's stressful. So we tend to stay in our houses, and housing space gets strongly reallocated. And there hasn't been, for various reasons, enough housing built. So there's a major housing shortage in many of our countries. And not only that, housing is far too expensive. So that the old benefit from high-valued housing, and the young can't get onto the housing ladder unless they have wealthy parents or grandparents. And that isn't in the model either. And the need to expand housing significantly, if the problems social problems are going to be met, hasn't really been fully recognized. Now, with that, I'm going to hand over to my colleague Manoj to carry on with the rather woeful story.
Thank you, Charles, and thanks to the LSE for hosting us. I will say before I start that one of the biggest problems in writing this book is Charles. So everyone is as productive and as much of a machine as he was, this book would never have any value at all. I'm hoping to have a fraction of his productivity today. I shudder to think what's going to happen a decade on from now. Since this is hosted by the Financial Markets Group, I thought I'd ad-lib a little bit and talk about 3 market pricing indicators about how financial markets are viewing a lot of this. And I had 3 in mind. The first one was the inflation-indexed 10-year yield, which is currently just north of 2%. And it's a level that it had a couple of decades ago. But the context of this real yield is incredibly different. Just a few days and weeks in financial newspapers, you've seen that hyperscalers have spent or are planning to spend about $750 billion this year in capex. At the same time, the One Big Beautiful Bill, whose main impact on the deficit this year is going to be about $600 billion. So something that about 2 years ago none of us expected is a $1.3 trillion increase in the demand for capital. And it's impossible to think real yields are going to come down. Now, this is a problem for the world because America's greatest exports is its policy stance. And so if 10-year yields are going to remain at the 4.5 or 4 to 4.5% range, no matter how good you are at maintaining inflation and deficits in your economy, you are going to have to pay a higher level, even though the spread might have narrowed considerably. And this is a problem for even those who have fiscal deficit, fiscal rectitude, and inflation discipline, and a much bigger problem for those who don't. The second market pricing I wanted to talk about is at odds with what the Federal Reserve tells us. So in financial markets, we work a lot out of forward yields. And so I tend to think that the 5-year nominal interest rate, the 5-year interest rate 5 years forward, is the market's expectation, such as it is, of the nominal equilibrium rate in the long term. And that has been remarkably steady since the Federal Reserve started raising interest rates. Now, what's interesting is 2 things about that. I would think that what the markets tend to call the terminal rate, which is the rate at which the Federal Reserve will stop hiking. I see that a simple proxy for that is the one-year nominal interest rate. What's interesting is that since 2018, there has been no point in time where the one-year has gone above the 5-year. So in the market's expectation, whatever increase in interest rates or decline before the great financial crisis we had was really in trend lines with the economy. There have, however, been 2 periods in which the one-year is significantly lower than the 5-year, which is suggesting an expansionary stance according to markets. And that has been for the period after the pandemic, in which everyone was clamoring, or a lot of people were clamoring for the Federal Reserve to raise interest rates, and they belatedly came to that party, and over the last year and a half. And that's interesting, because most of us will tend to think, looking at inflation and looking at where nominal interest rates have been, and listening to the Federal Reserve, that they have an appropriately tight monetary policy, not according to financial markets. And the last one I wanted to talk about, which is interesting because today is incoming chair Kevin Warsh's first press conference and meeting, is what's priced into financial markets. Now, over the last few months, we've heard a rationale from incoming chair Warsh that he would like to shrink the balance sheet, which made a lot of sense when they had mortgage-based securities. George Selgin's book called The Menace of Fiscal QE. If you hadn't read it, is really worth a read because it talks about quasi-fiscal QE. That made a lot of sense, but doing it at this juncture when issuance by governments is so high is something I'll address. And the second one is rate cuts based on productivity. Markets are pricing in a 30 basis point increase in interest rates by May of next year. So I think they are discounting heavily the ability of the incoming chair to influence monetary policy decisions anytime soon. With that, let me place the context of the rest of the discussion. So Charles talked a lot about fiscal policy, about what central banks would do, where real interest rates will go. I'm going to try and address a couple of things. One is the inflation side of that story, which has at least created ambiguity and ambivalence in markets since the pandemic. And I'm going to talk a little bit about the risks. One of the main risks is China. So as I'm going to discuss a little bit, China has had an incredibly large influence on inflation over the past decades. And if China's deflation or disinflationary impulse into the rest of the world for benign or malign reasons continues for a few years, whatever we say about inflation could get dwarfed. In our opinion, the stories that we get to read quite often in the Western press, we view them with a little bit of caution. So the broadest thrust of the discussion among Western commentators has been, look at China's current account surplus. The current account surplus has been driven to a large extent by falling export prices. And those export prices are a sign that Beijing does not want to commit to a strategy of encouraging consumption. So instead of doing that, the strategy is to deflate their way into a surplus in order to protect employment. Now, it's a consistent story, and it may be right. We have no gospel that tells us what exactly is in the mind of Beijing's policymakers, but we see some issues with that. Number one, the first one is that the trends of employment within China do not support this. So Chinese employment has moved aggressively out of agriculture, as we all know, but it has also moved aggressively out of manufacturing and into services. So the idea of deflating export prices in order to generate employment in a sector that is rapidly losing its ability to create employment for others seems a little bit difficult. Second, a lot of the deflation that you are seeing, which is in electric vehicles, in batteries, and in solar panels, is not only a function of the subsidies that the Chinese government gave a few years ago in order to catalyze or accelerate the production of these products. It's something that they don't like. So I don't know how many of you have heard of these strategies called anti-involution policies, which are trying to stamp out deflation. It didn't work very well in 2015 when they tried to cut steel and coal production. It's not viewed very favorably within China as a long, sustainable strategy, but it gives you an insight into the minds of policymakers. They don't seem to think that deflation, in order to create employment in the manufacturing sector, is worth taking a risk with their massive stockpile of debt. In fact, over the last month, if you looked at what they've done, they have tried to reduce the burden of local debt through a series of programs. So debt deflation seems to be a bigger concern for them. The second one, which we have absolutely no clue about, but it has never stopped us in the past, is AI. And if anyone does have better ideas, we're more than willing to listen to you. The way we saw it at this incredibly early stage is through a couple of lenses. One of them, which we haven't talked about here, might be controversial, but we just haven't seen enough evidence to discuss it at all. The first one is a point we've stolen off David Autor, who I think, I speak for Charles as well, has been very helpful in going through a lot of this literature. And the first thing he says is, you can't compare this shock to shocks in the past. So shocks in the past have generally ripped through the manufacturing sector. And the manufacturing sector tends to be either geographically or sectorally concentrated. So when a shock hits that particular industry, you either create massive pools of unemployment in a particular region or in a particular sector, and it's very hard to deal with them. But if accountants lose 20 or 30% of the output they were creating before Claude came in, they are dispersed through every small town and city, and it might be possible to absorb that a little bit better. Second, again, we were discussing before we came down, if the benefits of AI prove themselves over the next few years, some of the things that get us to those benefits are having an impact today. So right in my opening market pricing comments, I talked about hyperscaler spending. That massive increase in CapEx is something that is competing for capital right now, today. And we don't even know whether that will be beneficial. So in the last few weeks, markets, as you know, have flip-flopped between whether this is really a good idea to spend this kind of money on AI or not. As you've seen in the equity indices, the answer is no one knows. And the last one, which is something that's been talked about a lot, which is like past technological shocks, whether AI will lead to a collapse in employment. And we make 2 points. One is that we think there is some validity, if that happens, we don't know if it will, to the discussion of universal basic income. But what has not been discussed is how will you fund that? So to give universal basic income around, it would be foolhardy from a political standpoint to tax everyone, a general population, taking from one hand and giving to the other. It's far more likely that you'll see something like a tax on tokens, or view some kind of signal about higher profitability and lower employment at the corporate level as a signal of the use of AI, and tax the very companies who are driving up the stock market in anticipation of increased productivity. So it's not at all clear that the benefits that people are expecting in the equity market will stand if AI works a little too well. And the last point, again, we've made is that in the past, these stories have created ebbs and flows of employment. So there's a great paper with the title is impossible to forget, called The Surprisingly Swift Decline of US Manufacturing Employment by Pierce and Schott quite a while back. And they argued that after China received most favored nation status in the year 2000, a lot of the goods that were protected before by tariffs then started being produced in China, and at the 2-digit level were re-imported back into the United States. Now, that did create a large loss in the manufacturing sector in the US, hence the title of that story. But over that time, and some people may agree, some people may not, you would credit China with lowering inflation globally, and that lowered interest rates allowed gross effects of better growth in many other sectors and led to an overall increase in employment in the United States. So while you would create sectoral displacement, the overall impact might be very, very, very different. So where does that leave us on the inflation side of the story? Well, I'll make 2 points. In the interest of time, I'll cut a few other things out. We argue that what has been viewed in a very narrow sense and needs to change is the thinking behind inflation. And so when we see central banks discussing core inflation and the death of the Phillips curve, we tend to differ, because we believe there are, in almost every economy, with the possible exception of China, 2 Phillips curves. There's a Phillips curve that's generated domestically and the Phillips curve that's generated globally. So it doesn't hold for every economy. Obviously, we've cherry-picked a nice little chart to show you. But for the United States and the UK, services inflation, which Christine Lagarde and a lot of other policymakers clearly call domestically generated, tends to correlate extremely well with labor market conditions, and particularly with wage growth. And that's a story that does not apply as much to goods inflation anymore. In fact, if you look at goods inflation in here, you will have a hard time arguing that China did not have a role to play in delivering fairly steady inflation. So since this period in the early 90s, when goods inflation was about 3% and moved down to -2%, almost all of the disinflation in the economy has come through core goods inflation. In a very benign way. There was a positive supply shock that the rest of the world very happily absorbed. Since then, after the great financial crisis and after the pandemic, we've had malign shocks. China's housing market has collapsed. Their growth has been very weak. And yet goods inflation is the one that has done the lion's share of delivering disinflation. Can we depend on that? Which is why my first slide was mostly about China. And our argument would be no. If you look at the demography of China, they're far more likely to move into a current account deficit over coming decades. And if that is what we associated with disinflation, that inflation story or disinflation story is likely to flatten out. And you could get either a neutral or even a mildly inflationary impulse out of China, which means we can't depend on core goods inflation to keep bailing us out. And you may have to then start affecting the domestic economy or creating slack in the domestic economy with a smaller labor force would be a lot harder to do in the labor markets to get services inflation down, which brings us back to the points that Charles had made. I'll leave this aside in the interest of two other points that I want to make quickly before I hand it back. And that's two sides of the argument. One I've put in there specifically because of incoming Chair Warsh's desire to shrink the balance sheet. And the other one is the role of expectations. So typically speaking, I think the mantra that we all get is that, from central banks in particular, is that if inflation expectations are anchored, then we don't really have a problem with inflation, and inflation will stay within the range. We're not so sure. They may be right, but at the same time, that story may be completely the opposite. It may be that inflation expectations are stable if inflation is stable, and that doesn't really help the central bank. So in a very simple exercise, we took the 5 to 10 year Michigan inflation expectation survey and just looked at it against outcomes. And if you take a 5-year forward outcome, which is the green line, or a 5-year backward-looking outcome, which is the orange line, it kind of doesn't tell you that a period of inflation expectations trends translates into actual inflation behaving in that way over the next few years. But it does tell you that if inflation behaves a certain way, inflation expectations will tend to follow. So we don't believe this period in the future where we think inflation gets unanchored due to fiscal policy, due to a smaller role for China, is going to be something that will be contained by contained inflation expectations. In fact, we expect it to go the other way. And I'll make one last point before I turn it back, is while there is a lot of theoretical sympathy from our side to what Governor Warsh would want to do, which is to contain the balance sheets, practically speaking, is incredibly hard and goes back to the very first comment I made, which is about the real interest rate. If we think incredibly simply about governments and central banks, whatever the government issues and the Federal Reserve doesn't buy has to be bought by private investors. A large bulk of them tend to be central banks who are quite worried about possible financial repression. And you may have seen reports that came out in the last few weeks about the holdings of gold at external central banks going up. I don't know how much of that we can attribute to these kind of concerns, but surely some of it must be in there. It seems very difficult to think that that debt to GDP chart, which Charles showed you, which we believe is an underestimation of the challenges that come from an aging population, will go on the way it does, and the Federal Reserve is able to shrink its balance sheet over the time, which means the gap between the two widens so aggressively that real interest rates remain flat. That is a major concern, could be a trigger for something that's a slow burn crisis or a very rapid crisis. All in all, it points to a future in which central banks don't have an easy job. I don't envy them. No one should listen to me anyway in terms of monetary policy, but it looks like a difficult period ahead. On that cheery, happy note, I'll turn it back to you, Charlie.
Okay, we're at the Q&A stage now. Can I ask people, put your hand up if you want to ask a question. Can you wait till you get the microphone, and when it arrives, can you say your name and affiliation, please? And we'll start over there with the gentleman with the blue jacket.
Thank you very much, Charles and Manoj, for extremely interesting and thought-provoking presentation. Could I try and put to you a possibly optimistic scenario around AI? And I know that the only thing that's certain about the impact of AI is that it is uncertain. But some of the demographic shocks that you were saying have been up. You could make a story which says AI increases productivity and participation. You can also, I think, make a story which says that some of the trends in terms of ever-increasing healthcare expenditure and bigger government deficits could be positively impacted by AI, it's very unclear that you really need 550,000 civil servants to run the British state. I mean, it's unclear that you really need them anyway. But if you were serious about deploying AI, you could have a very credible story about reducing that to a sensible number. You might also be able to get more people off benefits and into work. So can we at least imagine a scenario under which AI deployment could help some of the adverse consequences suggested?
I think one can imagine anything, but ought one to make policy on a basis of hope rather than where we actually stand factually at the moment? And a number of the issues about AI, I think, have not been fully mentioned. One is that even if there's no overall problem with employment, there'll be some major problems in the redistribution of employment. What we are going to need in future years is a huge increase in the proportion of the population that undertake care, because the attempt to use robots and all that in Japan for care purposes have actually failed. There is no substitute for human empathy. On the other hand, what AI does is take away the need for low-level cognitive jobs. And what universities provide is cognitive jobs of varying levels. And one of the problems in future is we're going to have to shift much more towards an apprentice program for the young, and much less towards the expansion of universities. Indeed, we're going to have to face somehow or other the reduction of our total university intake, and that's going to be a problem. So let us hope that you were right. But I don't think that at this moment in time, one ought to base policy necessarily just on hope.
I'll add only a small thing, that if you look at the trends in immigration, the kind of immigration that we are preventing in our economies is exactly the kind of job that AI will not replace. In particular, to Charles's point, in May, I think, of last year, the UK government announced that they will no longer allow foreign workers for caring to come in. It's an incredibly short-sighted policy. I think some of the stories that can show a lot of productivity, I think will pan out. And what we have seen, again, quoting Autor, in the past, is that you have seen other sectors grow very rapidly out of there. So it's not at all clear that we will get a pretty dramatic decline in labor demand, and it's not at all clear that a lot of the new sectors that open up will all be incredibly productive. You know, looking at my 18-year-old son, the rise of TikTok certainly hasn't been in our house. Maybe elsewhere, but I think there's a lot of uncertainty around.
David? It's at the back there. And then I have one over here.
Thank you, David Aikman and Nita. Wonderful talk. I'd be really interested in hearing your views on the implications of this vision for financial stability, what financial stability policymakers should be thinking about, as well as hide at possible financial repression, inflation risk, be translated to the stability space.
I think I fear that the outlook is rather bleak. When I presented this paper at another meeting, somebody in the audience said, What you're talking about is a crisis of democracy. And I think that is exactly where we are. Because what we need to do is to get away from fiscal instability into fiscal sustainability, which would allow monetary policy to operate better. But to do that, you're going to need some very brave and politically difficult cuts in expenditure and increases in taxation. And they are very difficult. And the likelihood of our voters electing and our parliaments or Congress actually introducing these is, I think, fairly slim. If it is fairly slim, what will happen is increasing pressures in government bond markets, central banks having to intervene to keep them on the straight and narrow, and inflation still tending to rise, and the fiscal position, if anything, probably getting steadily worse. At some stage, a combination of inflation and bond market pressures will lead to a real crisis. And when we get a real crisis, then we will be forced to reform in the way that countries have faced crises. And one thinks of Ireland, Iceland, and Greece, among others, and it's pretty unpleasant. But the reform then happens, and they then do return to fiscal sustainability. But I don't see us doing it, or I find it hard to believe that we'll do it easily without having to face a crisis first.
So I'll spread that story geographically, broadly and very clumsily speaking. There are about 3 buckets of countries that show differing fiscal path. A very narrow set of economies that are really worth noting do have fiscal discipline, but they are very small. In the advanced economies, the only one I can think of is New Zealand, where the government is committed to showing a primary surplus over the next 3 or 4 years because they have low productivity and expect aging population to really impinge on their debt profile. In the emerging market economies, the most notable one recently has been South Africa, where the government has been very favorable towards better fiscal profile, and the SARB has added to that. If you look at Latin America as a country as a whole, almost all of them have fiscal rules. Some of them are better than others. Expenditure rules tend to be better. Mexico obviously hasn't really got a very strict one, but their debt to GDP is lower. But what's interesting is deficits and debt in that entire continent have moved sideways, while the rest of the world has seen a pickup. On the other side, you've got the US and Japan, where fiscal expansion continues. And in the middle, you've got a set of countries that are bumbling along, hoping that they'll be able to finance their debt and deficits as they used to in the past. So from the bulk of where the world's output and financial issuance comes, we don't have discipline as a whole, and I can't see a different world than the one Charles has described.
Hello, Will Goodhart from the Future of Sustainable Data. Sorry, Dad. I'll ask Manoj instead, because it makes it more interesting. Manoj, Dad talked a bit about sort of financial crises. Actually, that was going to be my question, is what kind of crisis might allow us to have the policy change that we probably need to see? I'll adjust the question slightly and say, what do you think the sort of the early indicators, the sort of warning signs of that sort of that fiscal crisis leading to a debt market crisis? Where and when do you think we might start to see that? And what might be the first indicators of that kind of event?
Well, the second part of that question is very easy to answer. It's government auctions. Government auctions have a thing called a tail. And when you start seeing government auctions showing an unfavorable outcome one after the other, real yields tend to follow that. So at least among financial markets, these auctions in highly indebted societies are watched incredibly closely. Who's buying those bonds, whether the foreign participation of central banks is higher or lower, something that I think Brian Sack has written about in the US a very long time ago. I think those are critical indicators for people who are looking at this on a day-to-day basis and then setting their treasuries and their real yield levels in their portfolios accordingly, which tends to drive up real yields. The deeper question about what sets it off is a period in which you show unsustainable fiscal policy, and that unsustainable fiscal policy can come from two ways. Either you show an unfunded fiscal expansion, which no one wants to buy, or you see a change in the growth profile of the economy. So if you could sustain a certain level of debt and deficits over a period of time, and you get a negative shock to growth that looks like a medium-term problem, people are no longer willing to finance that level of debt and deficit, and then that can have a spiraling impact. One thing I would add is that in emerging markets, the mechanism for controlling debt, and particularly in Latin America, has been fairly easy because yields are very high. And so when governments come in, they see that there's a classic way to impress markets, which is to cut your primary balance. And if you cut your primary balance and move it towards a surplus, markets reward you by lowering your interest expenses, and then everything starts looking good. That's a classic story. If you look in the United States, that story has gone the other way, where the primary deficit has gone up, and we're depending, or at least some people in Washington are depending on interest expenses coming down because the Federal Reserve lowers interest rate. Has never worked. I don't know if it will. I doubt it. I think those kind of trends are what people are paying attention to.
At the back.
Yeah, good evening. Brunello Rosa, LSE, among other affiliations. So my question is on central bank independence. So we all cherish, of course, if anything, as a former central bank myself. But then I wonder whether central bank independence works better or well in peacetime periods in which you can actually start thinking about different objectives, growth on the one hand and control inflation on the other, and with two different instruments, fiscal policy and monetary policy. What about wartime periods, the ones where we seem headed to, in which central banks might actually have another goal, which is making sure that there is a financing of government debt that is needed to pay for the war. After all, in one of your slides, Charles, you mentioned that in this period, central banks might be needed to do two things at the same time, making sure that debt is financed and inflation is somehow kept under control, and that none of that actually will be completely achieved. Thank you.
There are two immediate responses. The first is the great thing about wars is that they do come to an end. The problem with aging societies is it doesn't come to an end. It just goes on and gets worse and worse. The other thing that I would say is that in wartime, again, partly because it is thought to be temporary, there is a great deal of financial repression, and everyone is on board with that financial repression. So you get direct lending controls and all of that. So that a mixture of the belief that wars will be over fairly soon and that financial repression will help you get through it means that under those circumstances, although wars have temporarily led to periods of very high deficits and debt, they haven't led to the kind of financial market difficulties that we see coming along.
The end here, and then we'll come down over here to these two.
Am I next?
Yeah.
Oh, super.
Yeah.
Okay, Bill White. I'm with the C.D. Howe Institute in Toronto, Canada. Charles, you talked about the need and likelihood of financial repression, which we did at the end of World War II, and it worked a treat after 6 or 7 years. My question is, do you think it's possible to make it work in current circumstances? We have no capital controls. You know, we're coming at it from a very different place. Can it be made to work? And secondly, if it can't be made to work, which of the two alternatives is more likely? One of which is a crisis that incites reform, okay, and you eventually come out of it. But the other possibility, of course, is the Latin American possibility, which is you just gradually keep on financing the government and you gradually sink into hyperinflation. So 2 questions. Fiscal repression, is it possible? And secondly, what's the alternative if it's not?
Both questions are extremely good. To take one example, the particular reason why the corset got ended was because Nigel Lawson removed external capital controls, and that meant that financial institutions could get round the constraints of the corset, and it would become sort of, it wouldn't work any longer. And you were quite right. To the extent that there's freedom of capital movement, repression becomes more and more difficult. But I still think it will be attempted, though I think it will be quite largely porous, for the reasons that you point out. And it's a very good point that you make, that in a world of freedom of capital movements, financial repression is limited. Even things like taxes on banks, that financial intermediation simply goes abroad if the taxes are too high. Now, which of the alternative, rather gloomy alternatives you present, I don't know. I think I would rather have a quick major crisis and get it over with than drag on in a Latin American fashion. That would be my preference.
What do you think is more likely?
I don't know. I don't think one ought to claim to be able to predict the future when one can't, and I can't.
I'll just add that it took a very long time for Latin America to come through that period of really being questioned, hyperinflation, fear of floating, for them to design fiscal rules that were credible and actually listen to financial markets and be dictated to by financial markets. I can't see any of that. To be honest, it looks a lot like arrogant fiscal policy, which is very backward looking, which is you can still finance yourself and tell markets that you may or may not have an exorbitant privilege, but you'll still be able to do just fine. I think what we've seen out of the UK, what we saw out of France, the warning signs that came after the Japanese election from the Japanese bond market, and where we're seeing real yields in the United States today, these are warning signals. And if if an economy like the US has a mini crisis that lasts, I don't think 2 weeks will do anything, but if it lasts 6 months or a year, even if it's not a full-blown one, that could prompt some economies to really rearrange their fiscal position. But I don't think anything gets done without something like that.
Good evening, I'm Rashika Khedka. I'm currently doing my master's in investment and finance at Queen's University. My question is, if the government consistently overrides central banks in fiscal monetary conflicts, as you suggested, at what point does central bank independence become a legal fiction rather than an economic reality? So as we've seen in Zambia, in Nepal, political unrest has been extreme, and the central bank policies have suffered at the hand of that. So what do you suggest?
Yeah, I'll take a look at that. I'm not familiar with either of the cases, but there have been other important ones that have had different outcomes. So, for example, some time back in Argentina, there was a conflict between the government and the central bank about who actually owns the reserves, and that did not go down very well. But the similar conflict in South Africa has led to a much better outcome, which is the central bank telling the government that they will transfer reserves to them as long as the government followed a credible path towards using the reserves to pay off the debt. So it's not clear that every conflict really ends with an erosion of central bank independence. It could be different, but under these conditions where the critical element of that story, in my opinion, seems to be what is the share of non-discretionary fiscal incomes or fiscal expenditures in the government's budget. And if those numbers rise, and the central bank is forced to keep interest rates high in order to fight and change in the inflation regime, then governments tend to get tempted towards using political fiscal cycles during times of election. And I think that tends to erode central bank independence much faster. After that, I think all the things that Charles said start to apply.
Okay, thank
Dimitri Tomotos from Oxford. Since we are all friends, let me thank you about the thought-provoking argument and escalate the level of the thought-provoking discussion. Are we asking way too much from central banks to deal and reverse and counterbalance the real shock? Because most of your argument rests on real shocks, long-term trends, and actually political economy kind of argument shocks. Should we start thinking about other kind of policies, not only necessarily fiscal policies, but government policies, state policies, to reverse these trends that have generated all of these real adverse externalities, the long-term possibilities of the economy?
My answer to that one is yes. But that what I see is it's part of the fault of central banks themselves, because they've sort of allowed people to come to the view that they are so strongly powerful that they can control inflation. And you know, the three-equation model and all that, where fiscal policy doesn't even enter. If central banks had been a bit more humble about their role and what they could achieve, I think we'd be in a somewhat better position. Because the point that we're making is that they are constrained by circumstances around them, the kind of shocks that we get, but particularly the fiscal position. And in that constrained circumstances, they are unable or likely to be unable to achieve their objective, except temporarily, for the point that we made, that yes, central banks can always bring inflation down temporarily by raising interest rates enough, but unless you get fiscal rectitude, it just makes the fiscal position in future that much worse and simply drives the problem forward. So it's not a complete solution. I strongly agree with your overall position, but I think that part of the problem was that central banks, I think in some part actually believed that they were sort of masters of the universe, whereas their role and their abilities were limited by the context in which they found themselves, and they found themselves in an extraordinarily favorable circumstances between 1990 and about 2010. It was a wonderful few decades to be a central banker.
Kevin.
Kevin James from the Systemic Risk Center. So one implication I'm taking from your talk is I'm going to go home and stock up on guns and canned food. And the second question I have is, so the crisis is inevitable, or the crisis is in our future. Okay? Then, in one sense, that creates democratic paralysis, as you were saying, but also potentially creates the opportunity to force government to experiment before you get the crisis. So one option would be, like said, as Nicholas Beals talked about, the UK could do a lot more to just gamble on AI. So it may work, it may not work. Or maybe governments could be inspired to try and get work harder to get people into employment, which is solve a big part of the problem. So, given your analysis, but what area? Where area would be worth experimenting the most? Where is the biggest problem coming from? And so, if we could solve like one or two things that would maybe change your story, what do you think those would be? And then we could start thinking about what policies, or what Dimitri was saying, what real policies could take effect that would sort of solve this crisis for us.
If governments were made up of angels, and the electorate was prepared to vote for such angels, life would be a lot better. The problem is we've got the governments that we have, and the electorate tends to vote in terms of very short-term personal economic advantage, and also for social reasons that one may or may not actually think appropriate. As I said, I think earlier, I think that the situation we're in can well be described as a crisis of democracy.
I'll give you three parts which would affect our thesis the most, and I'll let you be the judge of how realistic those solutions are. AI, clearly, as the question suggests, we just don't know. If it turns out to be a silver bullet, I mean, we'll all be thrilled. I use Claude a lot. It's a fantastic program. It's built a few fantastic fiscal and monetary simulators for me. I love it. The second one, I would argue, is if you can find a way to cure or at least really postpone neurodegenerative diseases. But that's talking about the speed at which science moves, which I know even less about than AI. And the third would be changing immigration policies dramatically to fill the kind of roles that Charles talked about, roles that require empathy or actual hands-on care that AI can't really replace. But I don't know what the appetite of governments all over the world is to actually do anything about that.
Hello, I'm Simon Pradhan from Capital Economics, and this issue about democratic crisis that you're grappling with, we've had lots of questions that are sort of prompting you to come up with solutions and sort of what needs to be done in terms of policy, what sort of fortuitous events and trends may bail governments and central banks out of the predicament that you're forecasting. But one thing that we're assuming as a constant here are the democratic arrangements we have, and that you're assuming sort of institutionally government functions as it does now in terms of elected politicians making the decisions on fiscal policy. My question to you is, do you think that needs to change? As far as I can see, it can go in one of two directions. Either you follow the path of central banking and have independent monetary authorities move in a technocratic direction to take fiscal policy out of the hands of elected politicians if they are so fickle, or the opposite is to make voters better voters by empowering citizens to act in citizen assemblies and participatory budgeting exercises so that citizens are empowered to understand the trade-offs and make better political decisions.
I think the idea that we can educate the electorate is a nice idea, but it ain't going to happen. And I just don't think it's actually feasible. What was the...
Well, this is what your book is trying to do.
Yeah, but I
educate the media, and then the media can educate the electorate.
I think that's equally unlikely.
I think there is a segment that might pay attention. I don't think we're able to outsource this to them, is the classic bond vigilantes, but I'm not sure they have really reacted yet to the level because things haven't got scary enough. I think bond deals have to get a lot worse before their message actually filters through to the government. But I'll tell you that patience is wearing thin. They just don't have a big enough hammer yet. I'm with Charles on demography and everything else.
And one of the things that is happening and will happen, though we haven't actually talked about it very much, is that as the bond markets get more difficult, what will happen will be that those who issue debt will issue shorter and shorter and shorter, so that the effect of an increase in interest rates will be even more immediate than in the past. And that will mean the governments will be even less keen on central banks raising interest rates than they have been up till now. And that is going to make the government and the central bank even more sort of potentially at odds with each other.
Well, if you look at the US QRA, for example, about 75% of all debt that's financed in the US is financed through bills and the rest through coupons, which means short-term interest rates is about 70-75%, and the rest is done through long-term interest rates. So clearly, they're depending on a particular path of policy rates that will dampen the two-year yield and allow them to finance themselves. The question is, how will the bond market look at that, and what premium will they charge for the other 25% that's coming, and what that does to the weighted average interest rate that the government eventually ends up paying?
You've been very patient at the back.
Thank you. Hi, I'm Julie Cass. I'm an LLB student at UCL. And I wanted to ask, how do you propose fiscal sustainability be achieved when normal checks and balances for debt, such as debt ceilings, have been abused as a political tool?
How do you expect fiscal sustainability when debt rules are abused? Or
Well, if debt rules are abused, fiscal sustainability is not possible, and it won't happen. And you know, if you set debt rules and don't abide by them, you're on the road very rapidly to unsustainability and crises.
Do you propose any solutions, such as how debt ceilings are abused in the US, for instance?
Governments do what they want to do, and electorates elect them. The issues, and I always rather regret the fact that economics used to be called political economy, and that term is gone. Ultimately, our problems are usually political, and our problems today are political.
Can I give you an example very quickly of what Charles is saying? So the social security system in the US has a very well-known cliff by 2033. It right now is making payments to people who are owed that cash through a fund called the OASI fund. That runs out by 2033. Now the way Social Security is financed in there is the revenues come mostly through payroll taxes, and as the number of workers shrinks, particularly after immigration, and the number of people who are owed money increases, that system is going to have a shortfall. It's impossible for me to think that any incoming president or Congress will allow a median $15,000 a year hit to the US population. The people simply will allow that kind of debt or cheating on the debt fiscal rule to happen. How do you deal with that?
Misa?
Hi, I'm Misa Tanaka, currently affiliated with NISA and LSC, but until recently at the Bank of England. My question is there any criticism of the institutional setup of the central bank currently in your analysis? Or is this about just fiscal discipline that you're concerned about? So that's question number one. Number two is, would you think that LDI crisis is a good example of where independent central bank, which is separate from fiscal authority, has actually worked to discipline fiscal policy?
So the first one was whether there's any institutional...
in our book, there is really no criticism of the institutional structure of central banks, and I tend to agree with the argument that things like climate change ought to be a subject for government, not central bank. And I think that there are grounds for saying that the scope and a range of responsibilities that the central bank has tended to assume have been too great. But I think it's relatively minor, and our book is not about that the institutional structure of central banks needs any significant change. It's essentially about the fiscal problem. What was the second one?
The second one is whether the LDI crisis was a way of looking at central banks imposing fiscal discipline.
No, I don't think. The central bank bailed out the government on the LDI crisis and did it extremely well. And I think what the LDI crisis showed was that when the government's fiscal position becomes patently extremely unsustainable, then we will get financial stability problems, and the central bank will be bound, inevitably, because of its concern with financial stability, to step in. And what we're suggesting is that what happened then was a sort of canary in the coal mine, in the sense that the similar occasions are likely to occur again in future, and the central bank once again will be required to step in to support the bond market. No central bank can allow its own government's bond market to face collapse.
The trigger was a very technical thing in the LDI crisis, but I think the again, I'm very biased because I look at these things from a financial market standpoint. I think it was the bond market coming out and saying, I'm not willing to absorb the kind of issuance that is not funded by growth. And I would see the way Charles does, is that if the central bank wanted to be an influence on financial stability, it would have said, I'm not willing to interfere because this is a crisis of your own making. They wanted to soften the blow, which is understandable because you don't want to go down into a financial crisis, but that does create, I mean, look at our example. We saw that as a moral hazard problem because in the future, the government has some backstop in mind that even if we pursue a path that is not acceptable to bond markets, there is a non-zero possibility that the central bank can come in and stabilize the situation. So we have margin for error. If it wanted to remove it, it could simply have said, we're not going to do anything at all.
I'm Elizabeth Ellis, student at Kingston Grammar School studying economics. I was wondering whether you thought AI could potentially be another example of creative destruction, in that it probably in the long run will cause economic growth through innovation, with a brief period of unemployment and labour redistribution.
I think the answer to that is yes, but I would equally say that almost all technological developments introduce creative destruction. The question is how much creative and how much destruction.
And the sequencing.
And the sequencing, you're quite right.
Yeah. Up here.
Thank you so much. I'm Richard. I was a graduate student here a few years ago. Charles, if your premise is right that we are in an era of fiscal dominance and we follow the timeline, this country has a history of currency crises. The central bank can bully the bond market for a period of time, and eventually the bond market will go back in its box. But in terms of sterling, I don't see how risk capital will be financially repressed. I think there's already been significant capital flight out of this country, and I think it's accelerating. And if that does play out, then the only outcome can be some form of capital controls, as you alluded to. Do you think I'm off point there, or is that too negative a summary?
And you're quite right to talk about the fact that these kinds of problems may lead to declines in the value of the currency, and the value of sterling would go down. Now, I think that the question then is what are the reactions to that? Again, the old days, when debt was much lower, the reaction was to raise interest rates and raise them really pretty sharply when you got a currency crisis. But because the fiscal position is so weak, that would make the fiscal position immediately much, much worse. So if you can't raise interest rates that much, you've really got two alternatives. One, you could introduce capital controls, or two, you can try and deal with the basic problem, which is your fiscal instability, unsustainability. Now, introducing of capital controls, I think, would be taken by markets generally as an indication of utter failure and weakness. On the other hand, it would be a lot easier in the short run for a government to do it than to change the fiscal structure quickly and significantly. So which path the government would go to, I simply don't know. It would depend on the government, it would depend on the media, it would depend on public opinion. And we don't know what that would be at the time.
The question also on how quickly or when it could happen is, what's the alternative? Where do you take your money out of the UK that is substantially better? And where do you put it? Do you put it in Swiss government bonds where your yield is next to nothing? Or do you put it in the euro area where institutional arrangements and growth are weak? It's not the easiest question. Certainly the US is no place for fiscal rectitude at the moment. I think there is a risk clearly in what you're saying. I think even with the changes in the government that we could see, there are very few people who have the confidence to buy gilts aggressively at the moment because we don't know what the fiscal profile and the new chancellor might do. But I just think timing what you're saying into a currency crisis is very difficult because the rest of the world is in a not very dissimilar position.
It's a world problem. Okay, I'm afraid these are going to have to be the last two questions. One there and one in the back row.
Hi, my name is Goodhart. I'm here from the MSc Finance program at LSE. And both of you mentioned earlier that there is a need for socially acceptable taxation. And I believe that the taxation on the AI profiteers would be a very socially acceptable way to do it, especially when this is viewed as a source of unemployment for a lot of people. And you briefly mentioned a couple of ways that you could go about this kind of taxation in your speech. And I wanted to ask if you can expand a bit more how you would do this efficiently without suppressing the productivity gain that you would have from AI.
And basically you've hit the problem. The problem is that we need to change the fiscal structure significantly. Any change to the fiscal structure is difficult to do. Any really large change immediately would be very disruptive. And as I was talking about the shift to a land tax, could have adverse effects on financial stability in the short run. It is a very difficult problem. If it wasn't a very difficult problem, it would probably already have been solved. And we are where we are because the situation is not easy to solve. There isn't a silver bullet that will enable you to change from fiscal instability to fiscal sustainability and do it quickly. The best I think that we can do is to start moving in the right direction and indicate that we've got a long way to go and that we will go there. In other words, if there is confidence in the direction of policy and that policy will move sufficiently and with political support, then I think we can live through the fact that we cannot quickly find a silver bullet to put us right overnight.
On directly taxing AI, I think Bill's question on financial repression has some relevance there. If you decided to tax token usage in a particular country, commercial users of tokens would move those jobs elsewhere. If you decide to move your use or consumption of AI out of Asia or out of countries that would welcome you to start setting up shop there, taxation wouldn't generate much revenue. A lot of the capex that is being generated in the US today falls under some of the new capex incentives that the One Big Beautiful Bill gives you. So the classic elasticity that you would get in tax revenues, 1.1 as it tends to be, to nominal GDP growth, hasn't really worked. Because a lot of the growth, particularly in the fourth quarter, the first quarter, came from capex and not from consumption. And that has not led to significant revenue growth. So where do you draw the line between incentivizing future productivity at the expense of current tax shortfalls, which I think most of us would encourage? When do you stop saying that? Do you stop it when 2 years down the line? Really hard questions to answer. I don't think they're easier.
Okay, final question.
Natasha Postalvino from MSc. My question, we've talked a lot about fiscal dominance, and my question is about financial dominance. So I guess I would like to know from you what you think about where the current risks are in the banking and non-banking financial system at the moment, and whether you think that interest rate risk might be important, and what would be the consequences of that in terms of everything else that we've been talking about tonight.
We're very much in the middle of a Minsky cycle. And the Minsky cycle is one where you have a crisis, everyone says this must never ever happen again, and you tighten up regulation till you think that you've solved all the problems. And then things go on, and you move away from the crisis, people forget about it, and they say, with some degree of actual truth, that these regulations are impeding growth, and what we need is growth, and they're too great, and they're too complicated, and they take up too much time. So you start getting away from regulation. And you know, if a regulation is biting, it means that people don't like it. It's preventing them doing things that they would otherwise want to do. So there's a continuous sort of group for easing regulation all the time. And as the crisis goes further into the distant past, you know, the proponents of easing regulation become stronger and stronger until, you know, finally the situation ends up with a different kind of crisis. I don't myself think that the banking regulations have been eased to a degree that makes them particularly fragile. The fear is rather that the non-bank financial intermediaries interacting with asset markets, which in many cases seem to be far too optimistic, could lead to a turnaround in financial conditions generally, and not only in the government bond market, that at some future stage could have a very severe effect upon our system overall.
Okay, on that very depressing note, I'm afraid
it's good to be a pessimist. Things are almost always
a realist. I'm sorry for those who wanted to ask questions and didn't get a chance, but it's indicative of the provocative nature of the book and the questions that it raises. So if you'll join me in thanking the speakers again.